In today's video, we are going to explore how you can buy a house with very little money down and credit scores as low as 500. It's called an FHA loan, and we're going to cover the 2024 FHA loan requirements, answer some common questions about FHA loans, and show you basic FHA calculations, including how to calculate mortgage insurance. My name is Ivan Simal, and I am a mortgage loan officer in the great state of Nevada, and I appreciate you tuning in today to this week's episode. So one thing I want to clear up early in this video is that FHA loans are not just for first-time home buyers. There's a myth that only first-time home buyers can use an FHA loan. But that's simply just not true. Anyone can use an FHA loan, whether you're a first-time home buyer or somebody who has owned multiple properties. FHA loans aren't just for buyers with low credit scores or minimal down payments. While FHA loans do allow lower down payments and lower credit scores, you can have a credit score as high as 800 and put 20% down and still use an FHA loan. Look, the primary reason we are discussing FHA loans instead of conventional loans, VA loans, or USDA loans is because FHA loans have the most flexible guidelines for qualifying. They allow lower credit scores, lower down payments, and higher debt to income ratios, making it easier for many people to qualify for a home loan. I want to start with discussing credit scores. And yes, they are crucial for FHA loans, right? Because FHA loans, they allow credit scores as low as 500s, but there's a catch. If your credit score is between 500 and 579, you're going to need a minimum down payment of 10%. If your credit score is 580 or higher, you can qualify for the minimum down payment of 3.5% down. So let me just give you a really quick, clear picture. Credit score of 500 to 579, 10% down. Credit score of 580 plus, minimum 3.5% down payment. Most people looking at FHA loans will typically use the 3.5% down payment option, assuming they qualify. And so this is what it looks like in practice. $100,000 home, your down payment is $3,500. $200,000 home, $7,000. $300,000 home, $10,500. $400,000 home, $14,000. $500,000 home, $17,500 for your down payment. These numbers scale with the price of the home, of course. So FHA does have loan limits though. So depending on your location, they can vary. And so you have to look at also what's called a high cost area. So high cost areas have higher loan limits than low cost areas. And you can check out HUD's website to see if you are in a high cost area. And I'll put it down below in the caption. I'll put down the website where you can check if you are in a high cost area, or shoot me a DM or leave a comment down below and I'll make sure to let you know just to verify if you are in a high cost area. A key aspect of FHA loans is mortgage insurance. FHA loans get a bad rap for requiring mortgage insurance, but it's a necessary cost unless you can put 20% down on your home, which most people cannot. FHA requires mortgage insurance for the life of the loan if you put down less than 10%. If you put down 10% down, the mortgage insurance will fall off after 11 years. Mortgage insurance is not as bad as it's made out to seem. It's the cost of doing business, and without it, many people wouldn't be able to buy a home. Mortgage insurance does not protect you. It protects the lender in case that you default on the mortgage. So if you don't pay your mortgage or if you don't pay it, the mortgage lender is covered and they don't have to worry about the loan, because that is why you're paying mortgage insurance. A common question that I also get is whether you can refinance out of an FHA loan into a conventional loan in the future. And the short answer is yes, assuming that you qualify. You can start with an FHA loan, build equity, pay down the principal, of course, and eventually refinance into a conventional loan to get rid of the mortgage insurance. Let's show you how you can calculate the monthly mortgage insurance payment. Let's use an example of a $350,000 home with a down payment of 3.5% down. Purchase price, like I said, $350,000. Down payment, $12,250. We have a base loan amount of $337,750. Another thing that FHA also requires is upfront mortgage insurance, which is 1.75% of the loan amount. And you can finance this amount into your loan. And the majority of my borrowers, I would say 99% of my borrowers do this. Now, upfront mortgage insurance on a $337,000 mortgage times 1.75% is $5,910 with 13 cents. So that brings our new base loan amount when we add those two figures together, 337 plus 5,900, 343. I'm just giving you a flat number so that I don't have to say the whole figure again. How do we calculate mortgage insurance, which is 0.55% annually? So here we go, really quickly. So we take 343 times 0.55% gives us $1,800. I'm giving you a flat figure, but it's closer to $1,900. It's $1,889.13. So your monthly mortgage insurance, when you divide that by 12, is $157. So the monthly mortgage insurance payment on a $350,000 home with a 3.5% down payment is $157. Another reason FHA loans are so popular is because they allow higher debt to income ratios. Now, your DTI is the total of your monthly debt payments divided by your gross monthly income. Now, FHA allows up to a 47% front and a 57% back end ratio. Now, the front end ratio includes your housing expenses. So we have your mortgage payment, property taxes, homeowners insurance, and if you have any HOA fees at your property. Now, while the back end includes your monthly debt payments, so housing expenses plus car loans, credit card, personal loans, student loans, all those loans, that is what is included in your back end ratio. So let me give you an example of how we can calculate this. Let's say your annual salary is $120. That gives you $10,000 per month. Your front end ratio, this is how we're going to calculate it. Say you have $4,000 in housing expenses, $4,000 divided by 10,000 equals 40%, which meets the 47% requirement. Let's take your back end ratio and let's show you how we calculate it. It's essentially the same thing. We just plug in different numbers. So we take the housing expense of $4,000 plus any other debts. In this scenario, let's say you have $1,000 of additional debts. Your total monthly debt is $5,000. Divide that by $10,000. We have 50%, which is below the 57% requirement. Now, this example shows how you can qualify for an FHA loan even with a significant amount of debt. If you are wondering where to find a lender, guys, reach out to me. I would be more than happy to connect you with a lender that in an area that I'm not licensed in, or you can interview me and I would honor of helping you with your home loan. But there are professionals that you can find reviews, and you can also go to your bank or get a referral from a friend who's had a good experience, of course. And always compare quotes to ensure that you are getting a competitive deal, especially if you are working with an online lender and somebody that is not local to your area. FHA loans can only be used to finance primary residences. You cannot use an FHA loan for investment properties unless you live in one of the units of a multi-unit property, like a duplex or a fourplex, and you will be able to rent out the other 3 or 1 unit or 2 units, depending on how many units you have additionally. For single family homes, the property must meet basic FHA requirements, such as having a working heater, no peeling paint, no health or safety violations, and condos must be on the FHA approved condo list. Another one that's kind of like in between a single family residence and a condo is essentially a townhouse. Those are treated though as single family residences, so you don't have to worry about making sure that they're on any list or anything like that. To qualify for an FHA loan, you typically need a 2-year history of employment in the same line of work. Consistency is key right here. And while some job changes are acceptable, no large gaps or significant changes in job type because it can be problematic. Let's provide just a quick, simple example. Let's say you're moving from a steady W-2 job to a commission-based job without a history of consistent income. Now, this can make qualifying more difficult because we have 2 different types of jobs, so we can't really calculate that. Consistent income increases over time are favorable, but large drops or frequent changes in income can raise red flags. And underwriters really don't like that because it makes it very, very difficult to underwrite your loan and calculate your income and qualify you for a home loan. And the government doesn't like that either. While FHA loans offer many benefits, it's essential to compare them with other loan options like conventional loans, or if you're in a USDA type area, to compare them to that as well. And here are some differences. USDA is 100% financing, but you need to be in a certain area. If you're not within that area, you can't do USDA financing, and they're typically rural areas, right? And it's 100% financing. Now, for an FHA loan, it requires a little as 3.5% down, while conventional loans usually require at least 5%, but you can get away with 3% if you are a first-time home buyer. And if you want to avoid mortgage insurance on a conventional loan, you're going to want to put 20% down. FHA loans are more forgiving with lower credit scores, whereas conventional loans typically require higher credit scores for better terms. They both essentially have their own variation of mortgage insurance. FHA mortgage insurance lasts for the life of the loan, unless you put 10% down. And while conventional private mortgage insurance can be removed once you have 20% equity. Now, debt to income ratio. FHA allows for higher debt to income, as we've stated previously, making it easier to qualify for a loan if you have more debt. Interest rates for FHA loans are generally more competitive and often lower than those for conventional loans, especially for buyers with lower credit scores. However, the mortgage insurance premium should also be factored into the overall cost. FHA loans can be used to finance various types of properties, including single-family homes, multi-unit properties, condominiums, townhouses, as I've mentioned, right? So you are going to have options when you are obtaining an FHA loan. Now, there are additional requirements, and I'm going to go over them next. I touched on this briefly in the beginning. An FHA loan has specific property requirements to ensure safety and that you're able to live in that property. Now, the health and safety, of course, no health hazards like mold, asbestos, or any lead paint. There has to be structural soundness. So the home must be structurally sound with no significant defects. So part of it can't be falling off or wall missing or anything like that. Heating and plumbing and the electrical system must be functional, of course. And there has to be access to the property from a public or a private street. So there needs to be an adequate amount of access to that property. For multi-unit properties, FHA requires a self-sufficiency test. The expected rental income must cover the mortgage payment, including principal, interest, taxes, and insurance. This can be a hurdle in high-cost areas, but it's essentially ensuring the property's financial viability. I want to go over some tips for FHA loan applicants and how you can really prepare yourself. Improve your credit score. And this goes for whatever type of loan program you're going to be in. Higher credit scores, they get you better interest rates, right? It's just that simple. You don't necessarily have to save for a larger down payment. 3.5% down gets you into an FHA loan, but putting more money down can save on mortgage insurance and interest, of course, because it's the more money you put down, the lower the interest rate will be for the majority. Now, also remember reducing debt, right? Lowering your debt to income ratio improves your chances of getting approval. Now, if you have lower debt, which then in return gives you a lower debt to income ratio, it's easier for the automated underwriting system to approve you because it sees you as a non-risky borrower. Get approved. Knowing what you can afford helps the shopping experience and helps you shop with confidence because you know how much you can afford. This one should be first, but work with an experienced professional. Lenders and realtors that are familiar with your area and that are familiar with FHA loans and have dealt with FHA borrowers, they'll be able to guide you smoothly through the process. Now, I want to touch on refinancing options. If you start with an FHA loan, you have options to refinance in the future. The first one and the most common is an FHA Streamline refinance. It's very, very easy. It requires almost no documentation and there's no appraisal needed. The next would be conventional refinance. And this allows you to eliminate mortgage insurance if you have enough equity. So that's one of the main reasons why people do a refinance out of an FHA loan is once they've obtained enough equity in their property, they want to remove that mortgage insurance. So they'll go into a conventional product. I want to talk about what the role of upfront mortgage insurance, what it is. FHA loans require upfront mortgage insurance, which can be and usually is rolled into the loan amount. Now, this insurance protects the lender as stated, but it does add to your loan balance. So understanding the cost is crucial for making informed decisions about FHA loans. Look, I want to end it here. So in closing and in my conclusion, FHA loans are a very, very versatile and accessible option for many home buyers. I love it because it offers flexibility with credit scores, down payment, and debt to income ratio. Well, mortgage insurance, yes, it is a requirement. It enables buyers to purchase homes with lower down payments. So understanding the detailed requirements and calculations that are involved in FHA loans can help you make informed decisions. Whether you're a first-time home buyer or an experienced property owner, FHA loans provide valuable opportunities. If you found this video with value or if you found it helpful, please hit the thumbs up button and subscribe to my channel for more updates on FHA loans, mortgages, and real estate. For more detailed information, check out the other videos that we have in regards to mortgages and real estate. And guys, thank you so much for watching and have a great day.